The E-mini has been in a broad channel now since March. I think of it as a spike pullback channel, and a bull channel has a 75% chance of a bear breakout and a 25% chance of a strong bull breakout and an acceleration into an even stronger bull trend. It has pullbacks that last a lot of hours. Sometimes they're fairly deep compared to the prior leg up, and therefore it has a lot of trading range price action. And consequently, whenever there is a breakout, you have to assume the bulls will soon be disappointed. Two good bull bars, and then we got this rally, and then we got that breakout here, another breakout here, and then we got this. Well, we have consecutive bull bars. The odds are today will be disappointing for the bulls. In other words, the odds are against a third consecutive strong bull trend day. And that means today will probably either be a trading range day or possibly a bear day. We gapped up here and we gapped up here. This gap is small. Also, because it's a channel, traders sell at prior highs and scale in higher, expecting pullbacks to fall below breakout points. And some bears are selling here above this high, expecting the pullback will fall far enough down for them to make money. Even though the market's sideways here, the pullback here is fairly deep, and then ultimately it pulled back below the breakout point. And even if we go up higher, for example, if there's some big surprise on Wednesday's FOMC announcement, the market could suddenly break out even more strongly to the upside. I think the odds are it'll do this. One of these reversals, instead of being minor, in other words, a bull flag, will be major. We'll get a couple legs down to the bottom of the channel. The bottom, you can call it a wedge, you can call it a channel, but this whole broad bull channel, odds are is a bull leg and what will become a trading range, and that means that we'll test down to the bottom at some point in the next several months and then bounce. And then at that point, traders will say, oh yeah, it's obviously a trading range. So if we go down here and bounce, traders will say the trading range began over here, which it did. So right now, even though we're in a bull channel, I think we're in a trading range. We're obviously in a bull trend. And if you want, you can say that we're also in a smaller trading range here. Even though the past 2 days have been bull trend days on the daily chart, they've really been sideways most of the time. This day, you can say it was sideways here for 20 bars, and then sideways here for 40 bars. And then yesterday, the entire day was sideways. The bulls got a 10-bar rally at the end of the day, but the day itself was a trading range day. There's already a problem with the first bar. Did you see what it is? It's big. And therefore, even though the bulls are hoping for a double bottom with 68 and double bottom with 16, because the bar is big, traders buying above 1 need a wide stop, and that means the risk is big. And also, they'll be buying in the middle of the trading range, right below the moving average, and that means the probability is low. So even though 1 could look like a great bull trend bar, a lot of bulls will not buy above its high. One of the reasons why 1 could be another bull trend bar is, look at yesterday, first 2 bars, bull trend bars. And then look at Monday, first 2 bars, bull trend bars. In fact, we had a 10-bar or 9-bar bull microchannel on the open, but we had 2 consecutive bull bars on the open on Monday. We had 2 consecutive bull bars yesterday, and yesterday, however, we got a deep pullback. And today, the bulls will try again to get consecutive big bull bars. They do not want any sign of strength on the part of the bears, so they do not want the gap below yesterday's low to close. However, I think even though the bulls have a double bottom 68 and they have a bull channel, right, I think the odds are the trading range is more important than the bull trend bar, and there probably are more sellers at the 1 high than buyers. So I would not take that buy. At a minimum, the bulls are trying to get above the moving average and get up to yesterday's close. They want to test yesterday's close, but I think this is a low probability buy. Suppose bar 2 is a big bull trend bar closing on its high. Look at the screen. It's a trading range. The odds are that the day would be more like yesterday, selling off after 2 bull bars, than like Monday, where the market just rallied after 2 bull trend bars all day. Limit order bears so far did not make money. Bulls have consecutive bull bars like they had on Monday and Tuesday. Monday, the bars were moderately good, not especially big, but moderately good. And then yesterday they were slightly smaller. And today we have prominent tail on 1 and a fairly prominent tail on 2 relative to the size of the body. Therefore, even though it's a third consecutive day with consecutive bull trend bars, it's less strong than the prior 2 days. Yesterday was less strong than Monday, and yesterday we had a pretty good sell-off on the open. Any day can be a trend day, but the odds are against today being a big bull trend day. And because on the daily chart we had a pretty good move up on Monday and Tuesday, the odds were against a big bear trend day today. Therefore, the odds are today will be a trading range day, and that means there will probably be both a swing up and a swing down. When a trading range day is likely, the market often spends the first hour or so deciding on the direction of the first swing. And I think that's what's going on now. 60-minute chart, we're in a bull channel that's starting to go bend over sideways, but tight channel, pullbacks only 1 bar, 2 bars, 1 bar. So this is possible, but not likely. More likely, we'll get this. You can see traders selling above highs, selling above highs, selling above highs, selling, and they're selling above this high as well, at least for scalps. The market is increasingly two-sided, and therefore traders are willing to sell new highs, scale in higher, use wide stops, and bet they can make a scalper's profit. Limit order bears, 1 high, should make money, so we should fall 1 more tick at a minimum. Obvious targets are yesterday's close, yesterday's high on the upside, and then the gap below yesterday's low on the downside. As you know, I always pay attention to whether or not bulls and bears both can make money early on. If only one side makes money, it increases the chances that the day will be a trend day. If both sides make money, especially if bears make money after bull bars or bulls make money after bear bars, that increases the chances of a trading range day. So this is important, what bar 3 is doing. Can it fall 5 ticks below the 1 high and allow the bears to make money in the face of consecutive bull bars? If the bulls are strong, they got consecutive bull bars. If the bulls are strong, they should not allow bears to make money. What do the limit order bears do here if they're scalping? They hit their limit order a couple of times. Do they get out break even? A lot of them probably will. And do the bulls buy the too low after consecutive bull bars? I would not, because I think the odds are that, or at least I think the odds were that the bears would make money, that we would fall at least 5 ticks below the one high and at least 2 ticks below the too low. Confusing, right? We had big up at the end of yesterday, and then we have a gap down, so we have big down, and now we're trying to go up again. So up and down and up and down, all within a 4 or 5 point range. It keeps hitting the limit order for the bears. The bears should get their 1 point scalp. 1 and 2 are just not all that strong, and the context is good for a trading range day today. Yesterday was a trading range, and we have 2 not particularly strong bull days in a broad bull channel. What do you do with bar 4 if it's a bull inside bar, and if the bears do not make their money? You could, theoretically, that would be a sign of strength on the part of the bulls, and you might buy above 4, looking for a test of yesterday's close and yesterday's high. But this is pretty quiet, and it looks more like a limit order open. The bears sold above 1 a week buy bar, and the bulls bought below 2 consecutive bull bars. What happens if we fall below 1? It's a trading range, and therefore chances are anytime the market falls below a support level, there'll be buyers, not sellers. And anytime it goes above a resistance level, there'll be sellers and not buyers. And reversals are more likely than sustained breakouts, successful breakouts. It's really interesting how it keeps hitting the limit order for the bears and has not filled them. Okay, bears got filled. The bulls knew it was important to prevent the bears from making money, because if the bears make money after consecutive bull bars, the bulls know that reduces the chances of today being a bull trend day. And that's why they were trying to stop what just happened from happening. The odds of a bull trend day just went down. Limit order bulls, remember, they bought the 2 low, and they'll probably buy the 1 low as well. A limit order market, that means traders sell above bars, like above 1, and they buy below bars, like below 2. Bears trying to get a 3rd consecutive bear bar, like bar 5 yesterday, hoping that it would lead to at least a 2nd leg down. So 5 is therefore important. And the bulls who bought the 2 low are still trying to get their scalp. They probably will, because limit order days usually reward limit order traders. Bulls trying to prevent 3 consecutive bear bars, and they're trying to get a higher low, 2nd reversal up. This would be a higher probability stop entry buy than 1, but it's really not that strong a stop entry buy. It's more of a limit order buy at the low of 2. The bears did not do enough to make it short, so it's still always in long. Limit order bears made money above 1. Limit order bulls made money below 2. Stop order bulls hoping to make money. They're trying to get a resumption of the 2-day rally, but I still think the odds are against a strong bull trend day because we're in a bull channel, and it's unusual to get 3 consecutive bull bars. We got 3 here, fairly unusual, and now we're at the new high. You can say, well, Al, didn't we get like 10 right here? We did, but after the big bars, we got pauses, and I think the odds are today will be a trading range day. Bears want a lower high major trend reversal. We've had a bull trend for a couple of days, reasonably good sell off here, reasonably good sell off here. 3 pushes up to a wedge top. The bears want 2 legs down, 1 pullback 2. The pullback has 2 legs up as far as the bears are concerned, and the bulls say, yeah, it's still always in long, and we have a decent buy signal bar 5. We're always in long. Let's hold long. The picture is confusing. The market is deciding on the direction of the first swing. Today is probably going to be a trading range day, which means it'll probably trade down for 2 or 3 hours and trade up for 2 or 3 hours. While the market's always in long right now, it's not clear that this is the start of a 2 to 3 hour rally. The bulls probably will get out below 7 if it has a bear body, especially if it has a big bear body. And bears, if it closes on its low, below the moving average, they might sell. I probably would not. We have 4 bull bars in the first 6 bars. Every bar gives information. You can see how we're not getting the information until the final minute or so of every bar. And that hesitation, I think, is more consistent with a trading range day. There's less certainty, less conviction. A bar is not clearly strongly bullish or bearish right from the first few seconds. Will the bears get a bear body? Will it only be a 1-tick bear body, in which case some bulls will hold long, or will it be a 2-tick or 3-tick bear body, in which case a lot of the bulls will get out below, and the swing bears might sell for a second leg down from yesterday's wedge. 1, 2, 3. First leg down, pull back, and then second leg down here. Probabilities are just not good. It's not clear. We go a couple of bars up, a couple of bars down, a couple of bars up. Betting on a swing, a sustained move is a low probability bet. Okay. The bulls were able to prevent a 2 or 3-tick bear body, but we still got a bear body. And we have 2 bull bars, 1, 2, 2 bull bars, 5, 6, bad follow through both times. Therefore, this rally is probably a bull leg in what will end up as a trading range. So it's probably not going up all that far, and probably sellers around yesterday's close and yesterday's high. If we get up there, it's possible we get a small wedge, 1 pullback, 2 pullback, 3, and then a test down. I think always in long, the bulls have a decent buy signal bar 5, even though the follow through so far is bad. Bears want a wedge lower high and the start of a swing down, and the bulls want gaps. Bar 6 closed above 3, but then we had a 2-tick pullback on 7. So that is a sign of a weak bull trend. The bulls are again trying for a gap up here. They're trying to get 9 to close above 8. They prefer far above 8. I still think more likely this is a bull leg in a trading range. However, if we suddenly get a big bull bar, then we're probably going to get a measured move up. We're getting vacuumed up to yesterday's high, an all-time high, and to yesterday's close. The bears will try to get a wedge lower high, and then a swing down. Bulls have another gap, just like 6, but the bars are not all that big. So even though we're always in long, I still think probably sellers around where we are and around yesterday's high. I say around, above yesterday's high, below yesterday's high. Channel now is fairly tight, the bull channel, and that reduces the chances that a reversal down below 10 will get very far. We may have to go sideways more first. Bulls trying to keep the gap open, 8 high, 7 high, and bears want to fall at least a couple ticks below the breakout points, the 7 high especially. Every day the market does something, it makes some kind of a move early on. 50% of the time, the move is the start of a trend, like on Monday. We had a strong move on the open, and it was the start of a trend. 50% of the time, the strong move fails, like on Tuesday, pair of bull bars, and then we reverse down. And today, we have a rally, and it's not strong. We have consecutive bull bars, 1, 2, and 8, 9, 5, 6 also, but the bars are not very big, and the follow-through is bad. So it's more likely this will end up as a bull leg in a trading range. We got to within a tick of yesterday's close. The channel is tight. Right now it's a 5-bar bull, 5 or 6-bar bull micro channel, and a stop entry short below 10, not very high probability. Stop entry short below 9, even lower probability. It's important, like I said, if we fall 2 ticks below the 7 high, okay, we just did, that significantly weakens the bull case. And you can see how it went 3 ticks. As soon as it fell 2, it went 3, because a lot of traders will hold long 1 tick below 9, but if it falls 2 ticks below and 2 ticks below 7, they decide that it's probably not going to go up very far and will probably start to go sideways to down. So a lot of the bulls gave up when it hit 2 ticks below 9. Bears are hoping this is like 52 yesterday, the start of the swing down. But because the entire channel is tight, I suspect that we're probably going to go sideways rather than down. And for the bulls, I think it'd be really tough to hold long. You know, you're already back to the entry price. The bulls have bought 1 tick above 5. It's testing that entry price. Different bulls will use different stops. Some will get out break even, so they'll get out at that 9 low, which is at their entry price above 5. Others will place a stop 1 tick below the 5 high, which is 1 tick below the 8 low, and others will put a stop below 5, others below 1. This is for the swing traders. The scalpers are already out. The range is small, the bars are small, so if they bought below 2 or above 5, they scalped for 1 point and they're already out. Globex, we have a decent breakout of a bear channel. Odds are we'll go either sideways or more up. The odds are against it being a failed breakout, but it might be. It could be leg 1, pullback, leg 2, second leg trap in a bear channel. More likely buyers below, and we'll go sideways. You know, whenever it's difficult to hold on to trades, the market's probably in a trading range. You know, like yesterday on the way down here or on the way down here. The market kept going down, but very difficult to hold short when you get reversals with decent buy signal bars, right? And that usually means the sell-off is a leg in a trading range. And here, very difficult to hold long, and probably a bull leg in a trading range. Has not fallen below bear bar, did not fall below 7, did not fall below 10. So theoretically, if you had to be in the market, long is still the better choice. The swing bulls are still long, but I think it's really hard to be long. You're at the top of a weak rally at resistance, yesterday's high. This is the final bar of the first hour. We have a bull trend. We have a bull bar, but we also have an 8-bar tight range. So not a very good buy signal bar. Five-minute chart, I think confusing. We're still always in long, but the bears will probably get out below a bear bar. Excuse me, the bulls will get out below a bear bar, especially if it has a 2 or 3 tick bear body. It's a lower high major trend reversal, head and shoulders top, left shoulder head, right shoulder, and a possible high of the day. We're testing yesterday's high. We tried to get to yesterday's close, yesterday's high here, failed, and tried again here, and so far not successful. Because the first hour will probably close near its high and we're in a bull trend, if the tail does not get any bigger than it is right now, the market will probably have to go above the high of the first hour, which means if we simply go sideways here, we'll still probably have to get above the 9 high. If we get a bigger tail on the top of the bar, then it becomes less likely that we'll go above the high of the first hour. II, always in long, magnet above yesterday's high, but not strongly bullish. And for the bears, it's now a second entry short below 12, but just like 9, 12 is not a good sell signal bar, so probably the best the bears get is sideways. Also, that's the close of the first hour, and you can see we have a good bull bar, and it's in a bull trend. So the market probably has to go above the high of the first hour, which means we probably have to get above the high of the day, the 10 high. 60-minute chart, tight trading range. So even if you get above a bull bar, it does not mean we're going a lot higher, right? You can see we went above a bull bar here, reversed down, went above a bull bar here, went up for a couple bars, and then reversed down. Here we are, 10 bars after bar 5, 8 bars after bar 5 or so, and the bulls have not even been able to make 2 points. So just a reminder that even though always in long, not strongly bullish. It is a wedge with 2, 6, and 9. In general, if you break on above a wedge or any stop, 50-50 chance the breakout will lead to a swing up, like a measure move up. 50-50 chance the breakout will fail and reverse down. And I always change the percentages depending on context. Here, the context, I think, favors a failed breakout. So probably only a 40% chance that a breakout above the wedge top, the 9 high, will result in a strong trend. 60% chance it will fail and we will reverse down within a few bars. Wedge 9. Now we have a double top 13, but bad signal bar 2, bad sell signal bar 9, bad sell signal bar 13. So probably if we get a reversal, it'll be minor and will go sideways. This is not yet a strong top. Second entry short for the wedge. Second reversal down. Test of yesterday's close and yesterday's high, but only a one tick bear body, 14. Again, I think it's really difficult to hold long, but it's not yet a very good looking sell. Contact's good for the bears, right? It's a second failed attempt to get above yesterday's high, yesterday's close, and a reversal down. But a weak sell signal bar, 14. Excuse me, weak sell signal bar, 14. It's important to be patient. Everyone wants the day to be different. They want big swings, consistent follow through, clear reversals, but that's not what today is. So, I think it's perfectly okay just to wait patiently until the day becomes easier to trade. I'm currently flat. The bears want 2 or 3 consecutive bear bars closing on their lows. And the bulls know that, so they're going to try to prevent 16 from being a bear bar closing on its low. Bears are trying to reverse down. We tried to get above yesterday's high, and we reversed down twice, and now the market might try to get down below yesterday's low. Important bar. Is it going to be good follow through, or is it going to be a hesitation bar? Two-tick bear body, so okay for the bears, but the same problem that the bulls have or had, right? The bars are small, so we're probably not going to go all that far. Probably always in short, consecutive bear bars reversing down from yesterday's high. So probably sell the close, sell above 16, but I don't think there's, I don't think it's really important to be doing anything here. The day's range is very small, and we're in the middle of a trading range. So always in short, but I think most traders should just wait. This is pretty low in a trading range day to sell. For the bulls, it's a 50% pullback of the initial rally and 2 legs down, 1 pullback 2, but consecutive bear bars, I think a low probability buy. So what do you do? I am flat, and while the context is good for the bears, the bulls see this as a bull flag. Two-legged pullback, 1 pullback 2. The bears have 3 consecutive bear bars, only 1 reasonably big bear bar. So I think more likely sellers above 16, sellers above 17, but I think it's better probably to wait. Bulls bought the 10 low, right? Limit order market, traders buy below things and sell above. The bulls need another couple ticks to make their scalp, and the bears are probably selling here above 16. But if we break above the high of the day, we might get a couple legs up. You know, the bears have a wedge and a double top, 2 reversals down from yesterday's high, and if we started to reverse down. So if we reverse back up, you know, the bulls would have a decent chance of a gap and a measured move up. Best choice for most traders, flat, just wait. This is actually pretty good for the bulls, right? The bears tried to get the reversal, and now the bulls again are trying to break out above the 60-minute high. Is it still 60% chance that there'll be sellers above? I think it might be slightly less, you know, because now the bears had a reasonable attempt to trade down and they're failing, and therefore it might be 50-50 sellers above 14. I still think we're always in long. Maybe we were short on 16, but we're probably back to long here. Bulls trying to get their breakout and the measured move up. Bears want the breakout to fail. They're trying to get a reversal down from yesterday's high. Again, I still think the odds are against today being a big bull day. I said from the open that I thought it would be a trading range day, which it has been so far. Bulls deciding, well, the market's deciding whether we're going to get a measured move up or a failed breakout. I think it's slightly more bullish than bearish. The bears never had a good sell signal bar. The bulls have a decent buy signal bar, bar 5, and therefore normally I would look for a 4-point move. But when a day is small like this, a lot of times you only get a 3-point move up from that buy signal bar. So probably going a little higher, not necessarily a lot higher. For the bears, not a good looking sell below 20, 21, a bull bar. 5 bars without a bear body. Again, I think it's perfectly fine to do nothing and just wait. The range is very, very small. Makes it very difficult to make money, and we're getting a lot of reversals. Trading range days are always tricking traders into selling low, like 16 close, and buying high, like where we are right now, or the 9 close, or the 13 high. In general, trading range, when a market has a lot of trading range price action, you make more money with limit orders, and you make more money selling breakout attempts to new highs and buying big bear bars closes, like bar 10, bar 15, bar 16. Not a lot of experienced traders want to buy up here. Too much trading range price action. Also, it's a 6-bar bull microchannel, so not a lot of bears want to sell. So not much trading is taking place here. The bulls don't want to buy, the bears don't want to sell. A lot of traders are waiting for it to go sideways for a few bars and create either a second entry buy, like a small high 2 bull flag, or a second entry sell. Sometimes you get these days where you get 3 pushes up and it doesn't look like much, but it functions like a wedge. So 3 pushes up, 1, pull back 2, pull back 3. Like this, reversal down, second reversal down, third reversal down. So it functions like a wedge. But why are the bears not getting good sell signal bars? They haven't had one all day. That limits the chances that we're going to get a swing down. The bears will probably need at least a micro double top or a series of bear bars. And for the bulls, there's just not much energy. Every time the market goes up, it goes down. Bull bars down, up, down, up, down, up, down, up, probably down. So a lot of bulls are hesitant to buy when it's up. They want to buy when it's down. Everyone wants things to be clear, but trading range day, even though it's a bull channel so far, it's still a trading range day. And nothing is ever as clear as traders want. You can see it's turning down on bar 22. A lot of times the market has to go up for 24 bars before you get a top. So we may have to get back up to the 22 high and get a micro double top. After the first 18 bars right here, traders pay attention to breakouts and reversals. We got a one tick breakout above the 18 bar range. That means 90% chance we're not going to get down to the low of the day. The bulls are hoping this is a pullback from the breakout and that we will continue up. Bears are hoping that it's a failed breakout. I still think low probability stop entry short, but the limit order bears made money selling the 14 high. And we're still in a bull channel. That's the close of the second hour. And you can see we're sideways. I said that there probably will be sellers above the first hour's high. This is the entry bar for the bulls, and a bear doji, not a very good entry bar. Even though we're in a bull trend and we have a buy signal bar, not good. Tight trading range, top of the range, far above the moving average. What do you do here? Well, it's a trading range day, right? So, even with the three bear bars, they're all dojis. If anything, traders will be buying reversal attempts and selling bull breakouts. You can see they made money scaling in above bar 2. They made money selling above 12. They made money selling above 14. Now, if this is a strong bull trend, does that seem reasonable that the bears are making money repeatedly? No, that's not typical of a strong bear trend. That's typical of either a trading range or a bull leg in what will become a trading range day. In other words, a weak bull channel. For the bears, it's a failed breakout, 60-minute chart, but a terrible looking sell signal bar. So probably buyers at the low of that bar, which is at the 16 low. Most traders should be doing nothing. I think it's just too hard to make money, too easy to lose money. So I think it's better just to be patient. Bears trying to create a measuring gap, 25 close below 24, and then they want a measured move down. They want to get down to the low of the day. Really tight range, for about 15 bars here. Mostly a 2-point range, not worth trading. Too easy to lose money. The goal is to make money, the goal is not to make trades. Trading is fun, but you got to be focused on the goal. And right now I think it's very difficult to make money. Oh, he's in short yet? Looks like it. Looks like the bulls are giving up. What about the limit order bulls, 16 low? Trading range day, you got to be thinking that traders are going to make money buying below everything. So right now I'm assuming traders buying the 16 low, buying more 1 point lower will make money. But this is potentially a surprise bar. So I think we'll get at least a small second leg down. So I think we're always in short. You know, the bulls are trying to get back above that 16 low. This bar is bouncing around a lot. That means pretty big volume, or relatively big volume. At a minimum, the bulls want a big tail on the bottom of 26. They'd like to get one tick above the 16 low, and the bears obviously want the bar to close on its low, and then for the market to get down and test yesterday's low, today's low, yesterday's low. That's the break below the last hour, but not a good sell signal bar on the 60-minute chart. Bar 16 low, that's the breakout point. So it's important what's taking place here. Can the bulls get the close at or above the 16 low? In which case, the breakout has a better chance of failing. You know, look at the 16 breakout yesterday. It closed at the 13 low. Increased chance of a failed breakout. Again, trading range day, every time you see a big breakout, it's natural to think, oh, it's becoming a trend. And therefore, you know, traders end up buying, you know, the 9 close, the 13 close, the, 19 close, 21 close, and then they end up selling the 10 close, the 16 close, right? Trading range days always have big breakout bars that look like they're going to be the start of a trend, but it's just really easy to lose money, you know, selling breakouts near the bottom and buying breakouts near the top. Okay. We closed below 16, good for the bears, but the limit order bulls bought the 16 low and 1 point lower, and they need one more tick to make money, and the bears are trying to stop it. They're trying to prevent 27 from getting above the 16 low. They want to trap the bulls, and the bulls therefore would have to sell out of their longs. I think we're always in short. Big enough sell-off, probably sellers above. The bulls have made several attempts to get above yesterday's high, and usually if the market tries to do something several times and fails, it then tries to do the opposite. So probably we're in the process of working lower. The bulls are hoping for a double bottom with 5 and a failed breakout below 16. But right now, more likely, we're going to go at least a little bit lower and get at least a small second leg down. Is this a second leg trap? No, it's a first leg down, right? So it's not a second leg trap. Limit order bulls made money, right? So not particularly bearish. Now the bulls are hoping for a failed bear breakout and a double bottom with 5. I think the sell-off is strong enough so that we'll probably get a second leg down. So the first reversal up probably will fail. Can you buy here? No, I think if you're buying, you bought the 16 low and 1 point lower. I would not buy the reversal up. That's a big enough bear leg so that the odds favor a lower high and at least a small second leg down. Where do the bears sell? Do they sell the 27 high and 1 point higher, or do they place a limit order to sell 1 point higher, or do they sell 2 or 3 ticks above 27? I think all of that is fine. A 50% pullback is right here, so we're right at a 50% pullback. And for the bulls, I think they need to wait for a second entry buy. Even though it's a double bottom 5, it's a strong enough sell-off. Plus, it's a third failed attempt to get above yesterday's high. So I think the odds are we'll get a lower high. Not necessarily a bear trend, but a second leg sideways to down. Sell climax high, another target, the 25 high. Three consecutive bull bars, but trading range day. And a strong enough sell-off, probably the best the bulls get is a bounce here, which is what they're getting. Will we go all the way down to a new low? I don't know. It's a good enough reversal. A lot of the bears will want a micro double top like this. Is it a good enough reversal so that bulls will buy the 29 low? I would not. I think that's too high up to buy. And for the bears, they either sold the 27 low or they're selling around where we are, or with a stop up here. But because the range is small, very difficult to make much money. I think it's a problem for the bears that the bulls made money buying below 16. And the three consecutive bull bars are also a problem. Limit order bears who sold the 27 high, unable to sell more 1 point higher. It had to go 5 ticks and only went 4 ticks. Traders who sold the 50% pullback got filled here, and they needed to fall 5 ticks from there, so they needed to get down to just above the 27 low. What I did was, initially I placed a limit order to sell 2 ticks above 27, and I decided it probably was going higher, so I raised it 1 tick, and I raised it another tick, and then I got filled, and I just got out with 2 ticks. I decided I did not like the 3 bull bars. For the bulls, a higher low, but I still think we'll get a lower high that will fail to get above 22. Trading range days, which this is so far, usually filled with either a lot of wedges or a lot of two-legged moves. And a lot of times the two-legged moves subdivide into smaller two-legged moves. And this is a one-legged move, 1 pullback, 2, but the pullback might have 2 legs up, 1 pullback, 2. Even with the bull bars closing at or near their highs, I think the odds are, the bulls had their chance. They had a wedge, and the bears stopped them, got a double top. The bulls broke above the double top and failed again. So the odds are, we've seen the high of the day. Usually after 18 bars or so, 90% chance we've seen either the high or low of the day. We went to a new high after the 18th bar, but sometimes you get a small new high here, a tick above the prior 18 bars, and it reverses down, and then you get down to a new low of the day. Slight new 18 bar high. Here's bar 18, and we went a little bit above it, and then we went to a new low of the day. Here's the 18 bar high. We went a little bit above it and reversed down, went above it again, reversed down. This is not, trading this as an 18 bar range day is not very good. We got the breakout, we got a pullback, we got another leg up, but we went down to a new low. This is the kind of thing that I'm talking about today. A small new 18 bar high and reversal. Bar 18, we got a breakout above the 18 bar range, which is right here, and then a reversal, but did not get below the low of the day. So what happens if we get to a new high of the day? We broke above the 18 bar range, and the bulls are hoping this is a pullback and that we continue up. But with this much of a sell-off and this much trading range price action, if we do go to a new high, there probably will be sellers above 22. It would be an expanding triangle. Down, well, first we have a high, we have a higher high, we have a low, we have a lower low. Bar 18, never got above it. Because today's a trading range day, the 18 bar breakout I think is not particularly meaningful. You'd expect breakouts and you expect the breakouts to fail. So breaking above the 18 bar high does not mean we're going to have a trend up. Also, because the range is so small, even though the odds are we've seen the low of the day because we've broken above the 18 bar high, the odds are not as high as they would be on other days because the range is so small. So are we always in long or short? I think we're always in short, and I still think there are sellers above. And even if we do get above 22, I think there'll be sellers above 22. Can you buy up here? I would not. I still think the odds are we'll get a second leg sideways to down. That will get somewhere down near the 26 low. So I think more likely sellers above 32. The bulls are hoping that we have a double bottom bull flag, 5 and 26, and we're starting to reverse up, and this is a pullback from that reversal. The reason why I think we'll get the lower high is the bulls tried to get above the wedge with bar 13. It failed. They succeeded on 21, but it failed again. So I think we'll have a hard time getting to a new high of the day. Bulls trying to get a gap, but I think more likely there'll be sellers right around here. This is the close, or we're near the close of the third hour. Remember, coming into the day, I said I thought today would be a trading range day. And here's the first hour. The second hour is a doji, and third hour so far is a doji. The bulls are trying to get it to be a reversal bar. They're trying to get it to close near its high, but it's still asking traders to buy at the top of a 10 bar tight range and buy after a doji, and then the buy signal bar this hour is probably going to be a doji as well. So not a good 60-minute buy setup. Limit order bears selling 30 high. They need it to fall 5 ticks. I think they'll probably make money. It's a trading range day. I am, I'm flat. The range is just too small. It looks like a normal day, but we've been in a 3-point range for most of the day since bar 2 or so, pretty much in a 3-point range. Bulls want the breakout. Look at the 15-minute Globex chart. The dominant feature is this breakout. Bear channel, breakout, pullback, two-legged pullback. This went above that, but it's still, in the eyes of the bulls, a two-legged pullback. We went above the high of the third hour, but not a good-looking buy signal bar. It's a reversal bar, close above the midpoint, but a bear body, a doji, following another doji, and the top of a 10-bar tight range. Bulls trying to get the breakout here. Sometimes, middle of the day, trading range day becomes a trend day. In this case, the bulls are trying to get a bull trend day. It's unusual, but it sometimes happens. I don't know if I have any examples of it. No. This is something of an example, basically trend resumption up, or trend reversal. But this is not what I'm looking for. I'm looking for a day like today, where the day is in a narrow range, and then middle of the day, 9:30, second half of the day, it converts into a strong trend. Am I selling the 22 high? No, I'm going to wait. If we get a breakout with decent follow through, I might buy a close, even though the odds are against a third consecutive bull day. If it's happening, I'm not going to sit here and say, oh, that shouldn't be happening. I'll get long. Here's the Globex high. That's the next target. Bulls have consecutive bull bars, so clearly always in long, but the bars are not all that big. Expanding triangle. We have a high at bar 9, higher high, and a higher high still. Not a good sell signal bar. Probably buyers below 40, but there were probably buyers below 21, yet we pulled back very far from that breakout. You have limit order bears selling the 21 high. I would not, and I did not buy, so right now I'm trapped out. I'm more bullish than bearish, and if I were doing anything at this instant, I would be buying the 40 low, trying for a measured move up. We have a double bottom, we have a neckline, and then we have a breakout here, so might get a measured move up. Limit order bears selling 22 high. They needed to fall a couple more ticks. The bulls are hoping to keep the gap open 37 high. They definitely do not want it to close by 2 ticks. They don't get too upset if it falls 1 tick below the 37 high, but they don't want it to fall 2 ticks below, because that significantly reduces the chances that this is going higher. Expanding triangle, but not a good sell signal bar. High one buy, a pullback from a breakout, but 11 was a high one buy. Trend traders want more. They wanted good follow through after 26 on the downside. They want a good follow through after 21 on the upside, and they want good follow through here. And that is 41 is a disappointing follow through bar. You don't want a small breakout like 40 and then an immediate reversal. This is an example of a trading range day that had a bull breakout in the middle of the day and went up for a bottom measured move. You can see bad follow through after the breakout. But it just trended up the rest of the day. Do I think that will happen today? No. Usually if you have a trading range day, it remains a trading range day. It's important that the bulls keep the gap open. They want this to simply be a breakout test, a test of the breakout point, the 37 high. If they get it, it increases the chances that we'll work our way up for the rest of the day. Do I think it'll happen? I would say less than a 40% chance. Here we had 6 consecutive bull bars. It's actually pretty interesting if you think about it. I said the bulls, a lot of them will hold long, even if it falls 1 tick below 37 high. But a lot of them will get out if it falls 2 ticks below. And therefore, theoretically, you could buy here and put a stop 2 ticks below the 37 high, so you'd be risking about 3 ticks trying to make a measure move up. So I'm trying to make 3 points. Higher probability. Wait to see if 43 is a bull inside bar closing on its high and then buying with a stop above its high. You see, it's just totally crazy. Trading range day. Bulls have a breakout and follow through 39.40 yet. And the bears do not have a particularly good sell signal bar below 40. They could sell below 41, but that's not all that good either. Selling fairly far down. Let me see if there's a bond auction or something today. 30-year bond auction at 10 o'clock. So that's probably what caused 43 to behave that way. What do? I think nothing. If you sold the 22 high, you scalped out. If you bought the 40 low, you had to buy more lower. You need 1 more tick. It has to get 1 tick above the 40 low for you to make money. I think very difficult to make. I have not taken a trade in a while. I'm just waiting. I don't want to be buying near the top. While when you look at it this way, it looks like a normal day. However, when you look at it over the course of the past several days, this range is very tight. Here, despite the bull trend day, we were sideways for over an hour here and then sideways for 4 hours. Yesterday, we were sideways all day, even though we had a 10-bar rally at the end. And here we're sideways again. But it's, we're still basically forming higher highs and lows, so it's still in a bull trend. The bears have not had a convincing reversal yet. Nobody wants to buy high. Everyone wants to buy below things. The limit order bulls 40 low have not yet made money. It needs to get 1 tick above the 40 low. And the stop order bears who sold the expanding triangle below 41, a bear bar. It fell exactly 6 ticks, so a lot of them scalped for 1 point, not a lot of conviction. Stop entry traders have made money a few times today, entering with decent signal bars, buying above 5, buying above, I would say 31 rather than 27, and selling below 12, wedge double top, and selling below 41. But none of the trades was particularly good. You were scalping for 1 point, and the probability was not all that high, and the risk was big relative to the reward. Not a good buy signal bar. 4 bars without a bull body. Again, forcing traders to buy pretty high. I would not do it. Well, the bulls, they see this as a 50% pullback from this rally, and then this is a 2-legged pullback from this reversal, but nothing has changed. It's the middle of a very small trading range day. I think we're always in long, but the math is not all that good for structuring trades, and I think it's okay to continue to wait. That's an I, always in long, but again, really difficult math. Also, a lot of times between 10:30 and 11, 10 o'clock, 11:30, the market gives a setup that looks reasonable, and the probability is less than what you think, and it triggers the sell-up, the setup. For example, trading above 52 and then quickly fails. So the probability is less here than what you would think at other times of the day, in part because of the time of the day. For the bulls, it's a small wedge, higher low, but I think it's probably better to wait in the middle of a very small trading range day. Most of the trading has been within 2 points. Makes it very difficult to make money buying with stops or selling with stops. What do the bulls do, right? It's just an illustration of how it's difficult to make money when the range is very small like this. The bears have a double top with yesterday's high, and now they have a smaller double top here, but you're shorting in the middle of the day's range, and it's a limit order market. I think it's still better to do nothing. Theoretically, the bulls are still long. Let's say they bought above 55, but they would get out below 58. And for the bears, I don't think it's worth shorting. You're too low down, and you're in the middle of a very tight range. I think it's still always in long, right? We have a low of the day, we have a double bottom. The rallies have not been strong. We're still in the trading range. But if we are going to get a breakout, it probably will be up, but it probably will not be very far. I'm currently flat in the E-mini. For the past 20 bars, more than 20 bars, we've been in exactly a 2-point range. Not worth trading, better to wait. We might get, some little buy the close or sell the close rally at the end of or sell the close, sell off at the end of the day. But right now, I'm flat. I think the market's always in long, but it's, obviously, very neutral. If we are going to get a trend, which is unlikely, but if we are, it often starts around 12:35 or so. More likely, we're going to stay in a small, quiet day. So far, inside day, high below yesterday's high. It's exactly at yesterday's high, and then low above yesterday's low. Bulls trying to get their breakout at the end of the day. I think it's a difficult buy. because all the breakouts up and down have failed today. So I think it's probably not worth taking the buy. You can see it moving up and down, up and down, up and down, and that is always due to big institutional orders. Bar 78 always has a lot of volume because it corresponds to the final bar of the New York Stock Exchange and the NASDAQ Stock Exchange. So you have lots of hedging going on, especially in the final 10 seconds. So right now, 27,000 contracts. And the bar ended up with 42,000 contracts. So 40% of the trading took place in the final 10 seconds of that 5-minute bar. I think difficult to do anything right here. Very quiet day, very boring day. Trading range day like yesterday, but closed on a high. Like yesterday, trading range day closed on the high. And the day before was mostly a trading range day. It was a small pullback bull trend day, but most of the bars were sideways. We're very close to the 2,500 big round number. I said yesterday and the day before that we're probably going to go above 2,500 sometime within a week, maybe on the FOMC meeting. And daily chart, there's still a wedge, 1, 2, 3, but 4 consecutive bull bars, 3 with decent bodies. That's a low probability short, first reversal down, and therefore there are probably buyers below today's low. Let's say we gap down tomorrow. It doesn't change things. It's still 4 bull bars and a bull trend. So even if we gap down, the gap down probably will not last long. Here we had a month-long island top. We gapped up, we gapped down, and the gap down lasted 3 days. So I think there's too much buying pressure in here to create a big top. A major reversal down to the target, the March low, maybe the May low here. We have the FOMC meeting on a week from today, Wednesday, and that is the next magnet. This looks similar to this, and we got that, and it looks similar to this, and we got that, and we'll probably get the same thing. It's always possible that the market can accelerate up when you have a bull channel, but only about a 25% chance. 75% of the time, the channel just gets weaker and weaker and weaker and transitions into a trading range, and then you get a breakout below the bottom of the channel. Right now, this is the bottom of the channel, and then you start testing higher lows here, and usually you go, the pullback reversal goes all the way down to the beginning of the channel, down here, which would be about a 200-point correction. There's no fundamental reason for that to happen. It's purely a technical thing. Right now, there is no bad news coming out, and therefore the channel just keeps continuing and the market keeps levitating, keeps going up. For trading today, really dangerous day. Hard to make money unless you were trading with limit orders, and a lot of the limit order trades I think were difficult to take. Selling above 13, buying below 16, selling above 22. The day, I think, the first 2 bars of the day, consecutive bull bars, but not big, and tails on top, plus in the middle of yesterday's trading range, plus we gapped down from yesterday's close, and trends tend to weaken. So we had a stronger trend here, a weaker trend here. Today would probably not be a strong trend. It probably would be weaker than yesterday, and it was. So I thought today would either be a trading range day or possibly a small bear trend day. And that's the same with tomorrow as well. The odds are it'll be another trading range day, or these weak rallies will evolve into a trading range, and we'll start to test down to this low or this low or this low. Getting near the end of the week, 2 days left to the week, and right now the bulls have a good-looking bull breakout bar and no sign of a top. The big problem with the weekly chart is the one that I've talked about for the past 20 weeks. The market has been above the moving average for too many bars. We got close to it here. We got to within a half of a point, but we did not get there. However, that relieves some of the overbought condition. Back in 2003, the market got close. It got close. It relieved the overbought condition enough for the market to continue higher, and it stayed above the moving average for about 50 bars. Right now, we're above the weekly moving average for, I forgot, 43 bars or so, 44 bars. And, that's extreme buying. And this is what followed about 10 months of trading range trading. And this is about a 10% pullback from the high to the low. 10% pullback now would be about 200 points, and it would take us, maybe down here. But right now, no sign of a top. It doesn't matter that it's overbought. There's no sign of a top. Monthly chart, same thing. I forgot how many months this is. Maybe it's an 11-month bull microchannel, which is really unusual. That, therefore it is climactic and unsustainable. However, it's also a sign of strong bulls. As a result, when the market does finally pull back below the low of the prior month, it probably will not fall more than 1 or 2 or 3 months before the bulls buy again. It's unlikely to go from an 11-month bull microchannel into a bear trend. It usually has to go sideways for a few bars and get a micro double top first. So not much downside risk over the next few months. Anyway, always in long on the open. Closes bar 1. And then bar 5, we had a double bottom with 1 and a second entry buy, a decent looking buy signal bar, and went up 8 ticks. A lot of the bulls would get out below 12. You can argue wedge 1, 2, 3, and then double top. Possible high of the day, lower high, major trend reversal, bull trend, decent selling pressure, and this is a lower high and a micro double top. But I thought probably a minor reversal, and the best the bears would get would be sideways. And then when we broke to a new high on 21 above the wedge, in general, 50-50 chance the breakout will lead to a swing up. 50-50 chance the breakout will reverse like it did today. The reversal on 26, I think, was interesting. 4 or 5 consecutive bear bars. Probably we're going to go sideways. It's probably going to be big up, big down, big confusion, and sideways. And sellers above 27 and probably sellers above 22. I thought we would get a lower high. Instead, we get a higher high, an expanding triangle. This, in fact, is an expanding triangle as well. 3 pushes down, 10, 16, 26, and the bulls got the reversal up. On bar 29, 3 consecutive bull bars and it closing on its high. I thought we would go a little bit higher, but I thought we would end up going sideways. I thought we probably would not go above 22 without pulling back, but we did go above 22. However, we stayed sideways. For stop entries today, buying above 3 made sense. I would not short below 13 or 12, although you could for a double top and a small wedge. The channel was so tight, I thought sideways was more likely. And as for selling below 21 or 22, I would not do that either. We got 5 bars here without a bear body. Probably the reversal down will be minor, and it was. It fell below 16, but it was minor. Buying above 27 for the expanding triangle and the double bottom, I would not. If you're buying with a stop, probably the buy is above 31, a bull bar closing on its high, and then no stop entry trading through here. I mentioned 55 is a wedge, 3 pushes down, 45, 48, and so it's a wedge bull flag. We have a reversal up and a pullback to a higher low, but a lot of the bars are only 2 ticks tall. The day's range is only 5.5 points tall. I think not a very good stop entry buy. even the bulls who bought the bar 5 high and held all day, we still have one bar left of the day, but they had not made 4 points. 90%, 95% of the days, there's a stop entry trade that looks reasonable, and it results in a 4-point move. But there are often pullbacks that you have to sit through. And bar 4 is that bar. But I mentioned earlier that the range was so small that the bar 5 bulls might only get 3 points. And you can see we went 14 ticks above the 3 high over here. And that tells me that a lot of the bulls who bought the 5 high, they held here. It did not fall below the signal bar low. So they could argue that it's still long, and they ended up making 3 points on their trade. But a lot of them did not get out with 3 points. They held, and they probably get out here with 2 points or slightly less. Buy the close, sell the close. 2 is buy the close, but probably limited upside. The bears who sold the 1 high made money, and we have the big tails on 1 and 2, middle of yesterday's range, probably not going up very far. And then 6, another pair of bull bars, not great by the close. It went up 5 ticks from that 6 close. So if you bought the 6 close and you thought about scalping for 1 point, you made your 1 point scalp. 26, I think technically you could argue sell the close because the close was below the 16 low. I mentioned that if it closed at or above the 16 low, it reduces the chances for the bears, and it increases the chances that the bear reversal will fail. I thought it was a big enough move down so that we would be sideways or maybe get a second leg down. And 43 is probably the second leg down, but it could not even get down to the 26 close. And then for the rest of the day, I would not buy or sell closes. If you're buying or selling closes and you decide the day is a trading range day, and pretty early on, bar 1, bar 2, bar 3, I said it was probably going to be a trading range day. If you're going to be buying or selling closes, it's better to do the opposite. When you see a strong bull breakout or a big bull trend bar near the top of possible range or the top of a leg, traders sell. So they look to sell, maybe the 9 close and the 13 close and the 19, the 21 close, 39.40 and 77. And they do the opposite with bear closes. Buy 4 close, 15, 16 close, 26 close, and too late in the day to buy 79. It sounds easy, and when you look at the chart, it's clearly the right thing to do. But in practice, it's difficult to do. And even if I'm really sharp and aggressive, I used to be much more so years ago, it's still hard to catch all of them. Limit orders, it was all limit order trading. When the bears made money selling above 1, a bull bar, closing above its midpoint, it told us that the rally was probably going to be weak, and therefore traders will be looking to sell new highs and they'll be buying pullbacks. And all day long, traders did that. They sold above bars and scaled in, sold above 2, scaled in. Bought below 10, bought below 16, sold above 22, and then bought below the 39 buy climax, bought below 38, and then through here sold this high and bought the 50 low. And at the end of the day, they sold the 74 high, scaled in higher. They sold the high of the day. But I think, again, easier to do, easier to say than to do. You got to give the bulls credit. They have 3 decent bull bars on their breakout to new high, and no sign of a top. However, we have the FOMC meeting next week, and we're in a bull channel, and the odds are every time you get a new high, you go sideways, new high, sideways, new high, sideways, new high. Probably this is what the next several days will look like. We have that FOMC meeting, and that could create a surprise. It could be either way. The big surprise would be a strong bull breakout with good follow-through. But the bear surprise would be a big reversal down with good follow-through and the start of a march down to a sell-off down to the March low. I know that, okay, questions. I know that you do not have a lot of losing trades, but can you discuss any losing trades or break-even trades? Just like there's an art to winning trades, there's an art to break even and taking a loss. I mentioned one today, I forgot. I sold the 50% sell-off, a pullback from the sell-off over here. I forgot where I got filled. I got filled somewhere around here. And then I was disappointed by the 29 close, and I placed a limit order to get out with 2 ticks, which I did. And beyond that, I usually don't let trades go very far against me if I'm scalping. If I'm scalping and I think my premise is still good, I'll use a wide stop and scale in. If I'm scalping and the market is telling me that my premise is no longer good, then I get out. But in general, it's rare for me to get, any kind of a significant loss. My losses are small, but when you're scalping, your rewards are going to be small as well. And I did not. I think that was my last E-mini trade today. I just stopped trading. In general, if the range is mostly within a 3-point range, I stop trading the E-mini and I look elsewhere. Every now and then I'll talk about management of losing trades or break-even trades. I don't talk about them all that much, but I'll try to mention more of them over the next week or so. Question, I sold the 15 close right here and got stopped out. Seemed like a good entry for a second leg down. Was this an okay setup? Okay, a question like that always goes back to the premise. Okay. So we have a wedge lower high, major trend reversal. We have a bull trend, decent selling pressure, and then we have a weak rally to a lower high. It's a wedge lower high. And then we have a second entry, a micro double top, second entry short with a bear body. I think that is an okay short. He sold the close of this bar, taking a chance that we're going for a swing down. Now, can he sell that 15 close for a scalp? Well, look where the market is. 15 close, it's in the middle of a tight trading range. It's too low, I think, to scalp, unless you get an exceptionally huge bar, which 15 is not. So selling the 15 close is a swing, and then at some point you have to decide that the swing is not valid. A lot of traders would get out above 13 and just take the loss up here. I think that if I were swing trading it, I would either do that or get out above 19, a bull bar closing on its high, double bottom with 10. We push down and we push down again, and the breakout and follow through not all that big. So I think selling the 13 close or the 15 close is fine, but I would not do it for a scalp. And if I did it for a swing, I would end up getting a small loss. Question, when is an opening gap likely to trend in the opposite direction? Okay. I talked about that. I think Monday was a good example of how to look at it. In general, anytime you have a strong move on the open, up or down, 50% chance it's going to fail. That's my starting point. If we have a gap up, 50% chance we'll get a reversal down. If we get a gap down, 50% chance we'll get a reversal up. If we have a very big gap up, and if the context is good, the odds are more like 60% that we're going to go up and only 40% that the reversal is going to fail and that we're going to reverse down. And then once we get the close of the first bar on Monday, I don't know if you were in the room, I talked about it. As soon as you get a pretty good bull bar, the chance of this being a bear trend day drops even further, maybe 30%. And then you get consecutive bull bars 1 and 2. The chance of the day being a big bear trend day drops even more, maybe 20%. But if 1 was a big bear bar, then it would be at least 50% chance that we would reverse down. So the size of the gap, the context, is the gap up still within a trading range, or is it gapping up to a new high? And this was an example of a gap up to a new high. So at a higher probability of following through. First bar, decent size, and close on the high, higher probability follow through. Second bar, decent size body, closing on its high, probability goes up even further. But in general, anytime you get any strong move on the open, a gap or a big trend bar, 50% chance it's going to reverse. And then you look to the left and you see what the context is, and you adjust the percentages. And then you look at the strength of the move. Is it a huge gap? Is it a huge bull trend bar? That makes a reversal less likely. And then look at the follow through. If there's good follow through after the big gap up and the good bull trend bar, that further reduces the chances of a reversal. Okay, question. I feel that the E-mini is for algorithms and big players who are scalping thousands of contracts, positions. Even on good days, it doesn't move much, which makes it very difficult to learn from you. And the charts don't look like the ones on your course. Could you do a webinar or something that is easier to trade, like the Euro, the 6E? In the E-mini, all markets, they vary. And the past 3 days, we've had a lot of trading range trading. And you said that the market is dominated by algorithms, and it is. I don't know what the percentages are, but I would guess that 95% of the trading is institutional, and I would bet that at least 70% of it is done by algorithms, computers. And a lot of it's done by high-frequency computers. I don't know what the percentage of that is, but I would guess that at least 50% of it is done by high-frequency computers, scalping for 1, 2, 3, 4 ticks. All the computers sense what the market is doing. Is it strongly trending? Is it weakly trending? Is it a trading range? Are we getting a lot of reversals? And if the market starts to do something regularly, like let's say we've been increasingly two-sided over the past 3 days, every day more and more two-sided, more and more computer algorithms are switching from trending mode to trading range mode. And once a critical mass of them switches to trading range mode, there will not be enough institutions taking the opposite side of their trade. So if everyone is looking to buy low, there's no one who's going to sell low. If everyone is looking to sell high, right, then everyone's selling high, nobody's buying high, there's no one willing to take the opposite side of the position. And all of a sudden, that type of algorithm fails and the market breaks into a trend. So the market's constantly alternating between trending behavior and trading range behavior. The charts that I use in the course I selected to illustrate points. This is not a typical day, right, where the market is mostly sideways. I have a lot of trading range charts in the course, and the reason for that is most days are mostly trading range days. You know, they swing for a while, but then are mostly sideways. You know, that's what most days are. They have a lot of trading range trading, and that's why so many of the charts in the course, are trading range things. As far as doing a webinar on something easier like the Euro, the 6E, the 6E, I think, is difficult to trade on the 5-minute chart. And there are a variety of reasons for that. I talk about them in the course. And one of the big reasons, the 6E is the Euro. So here's the Euro. This is the Forex market, Euro versus the dollar. 6E is the futures contract version of it, which is the same thing. Here's the 6E, the Euro. I don't have the price scale adjusted appropriately, but I think it's basically the same as the E-mini. Scalping on the 5-minute chart is difficult because the average bar is smaller than the minimum scalp. For me, the minimum scalp in the Forex market is 10 pips, and that would be 10 ticks in the Euro futures contract. but the average bar is smaller than the average, than the minimum scalp. And that means there will be far fewer scalps in a given day than in the E-mini. So if you're trading the euro, it's probably better to trade a slightly higher time frame chart, like a 15-minute chart like that, or a 60-minute chart. Today was interesting. I wrote this morning that I thought the euro was forming a lower high and then it would sell off. And this morning, through here, I'm getting ready to start writing. Then we start doing this, and I'm thinking, this is going down, I should sell. But, I was talking, I was writing the update, and I did not sell. I obviously did not buy, but I ended up not selling. This is unusual to get a 100 pip day. It's more than 100 pips tall. Most of the time, the euro, like the E-mini, is sideways. It's like this. And, it's like this. And, this is a 5-minute chart. And you're mostly scalping. I want to say one other thing about the E-mini. If you think about it, if you're buying with a stop above the high of a bar, you're betting on a successful breakout. That means there's an institution selling with a limit order at the high of that bar, betting that you are wrong. And you have to assume an average institution is going to be right about half the time. An average institution is going to be wrong about half the time. So in general, half the time stop entry trades are profitable, and half the time limit order trades are profitable. I think when traders are starting out, they're better off sticking to either stop order trades, and today is not a good day for that, or buy the close, sell the close trades, strong trend trades. Like here, buy the close, and buy the close, right? There are also stop order trades there. I think as a beginner, I think those are the two best types of entries. But you get killed on a day like today, because early on we knew it was going to be a trading range day, and trading range day breakout stop order trades. A stop order is a breakout of the prior bar. You're going to lose. It's far easier to make money with limit orders. The more charts you look at, the more you start to see all kinds of stuff. And half of the stuff is limit order trading, because at least half of all trades are limit order trades, half of all profitable trades. Even though today was a very quiet day, there probably were 20 reasonable 1-point scalps, but it's hard to take them all, and it's hard to see them real time, but it takes practice. But as far as doing a webinar on something else like the euro or bonds, I personally like bonds. I trade the euro, I trade bonds. I tend to be partial toward bonds because they trend so well. Right now, I still have a lot of stuff going on. I still want to finish the course, but once I do, then I'll be looking for other things, and forex markets, bonds, options, that will be the direction that I will go. But for the near term, for the next many months, I have to finish the course. Okay. Okay, that's it for questions, and my voice is wearing out. But I know it's really, on a day like today, it's really frustrating. You look at it and say, this is not what I want. Who's trading this? How can anybody make money doing this? Obviously, a lot of trades are taking place. Even on these tiny bars, 2 ticks tall, you got thousands of contracts trading. But it's not you or me, it's institutions, and it is algorithm trades. Some of it is people like you and me. They'll see a bull close after 2 or 3 legs down. They'll buy the bull close for a scalp. But, most of it is institutional and program trading. However, this is not going to continue. As I said, the days are shrinking over the past 3 days. We started to get sideways here for 40 bars. The entire day was sideways, but decent range. And today, the day is sideways, but an extremely tight range. This increases the chances that we're going to get 2 or 3 trend days. The market might wait for the FOMC meeting a week from now, but I think you have to be prepared for some kind of a pullback. Whenever you have a rally like this, you can call it a spike pullback channel. You usually get a sell-off that tests back down. So I think before the FOMC meeting comes out a week from today, we'll probably get 1 or 2 sharp moves down. We're right around the 2,500 big round number, and I think the market wants to get there before we pull back. But I don't know. I'm open to anything. But I understand your frustration on the, especially on a day like today, where there's very little that you can do. You can look at the Nasdaq. Looked a little bit better today, but it's not all that good either. Nasdaq had some decent bars, a bull flag, and it just turned into a scalp, micro double bottom. It went up a little bit, but this kind of a day happens, maybe once every month or two, and I usually just let take some trades early on, and then just wait to see if it breaks strongly one way or the other, and if it does not, I just sit it out and look for trades in other markets. Okay. I do think we're not going to continue like this much longer, and we'll probably get a trend day either tomorrow or Friday, because that's what usually happens. Once the trading range behavior becomes more intense over several days, the algorithms are all geared toward trading range trading, and today was probably enough to make all of them trade the same way, and that means probably we'll have to break out. All right, hope everybody has a good night.